All right. So, what is trading? Trading, in essence, is just the market moving. So, are we going to move the market? No. Even if you have $1 million account or a couple $1 million, you're not going to move the market any significant amount. What moves the market? The banks. So that's why when we're trading, we are trying to piggyback off the banks and predict where price is going to go, where the banks are going to predict it to go. So, just real briefly, in case anyone didn't know, the green candles, the bullish candles, when you're predicting price will go up, you're doing a long position, a buy position. Then the red candles, bearish candles, those are downward movements. That's when you're predicting that price is going to go down. It's called a short, a sell, anything like that. So, for you to get in a position in the market, someone has to get kicked out. This is a neutral game. It's a zero game. So, for you to do good, someone's going to have to do bad. And it's really that simple. So, the way that market moves and the way the banks move market and where they want it to do is to make them the most money, to make it so that they can give out positions for enough money for them to make something and then you to get your position. So take someone out of the market for a high amount of money, or actually no, for a low amount of money. The banks try to kick you out of the market for the cheapest amount and then sell your position to someone else for a markup. That's why it's always going to cost more to put in a buy, and same thing with sell. It's going to cost you more than it costs the banks. So, in essence, any strategy is pretty much just predicting that price is going to go up. Like for here, for example, price is going to go up to take out people that have short positions, or it's going to go down to take out people's stop losses that have upward positions or longs. So that's basically it. I mean, you don't really need to know a whole in-depth thing in this. That's about all you really need to know. So, from that, now that we have a basic understanding, that's what liquidity is. Liquidity is just a jumble of where people put their stop losses for different strategies, all of that good stuff. So, right here we'll just go, for example, clearly the banks wanted to move market down. Here up, here down. And that's the basics to liquidity. So, from there, we'll go into the next little segment, which is how do we spot a trend? How do we kind of just see it developing? You don't, unless it's a very high time frame, you don't really want to take a trade off of just spotting the trend. It's okay to like go back in and test this shit and all of that. And I would definitely recommend it. I mean, after this video, I'll give a little bit of homework, just like TJR does, but it's pretty simple. So, this is all gonna be dependent on what timeline, what candles you're following. I've seen some people trade 1 minute candles. I really wouldn't recommend it. I would say 5 minute is like the smallest candles that banks will actually respect their structure and affect it. But we'll go over here. So, right here, we have these candles here. And we have this candle right here, this one right here. So this would be the high, this would be the low. And would we trade off of anything in this time frame? Hell fucking no. So we wait and we wait, whatever. So even just here, we can see this green candle. We'll zoom in for this. So this right here, this is the body of the candle. This is a bullish candle. This is the body. and then this part is the wick. So we will never trade off of a wick. It's very stupid. You go over here, you get my little ray. So this wick, why don't we want to trade off that? That's just somewhere that price has touched. That's not where price ended up. So if we have this wick here, this is the highest that candle went to, and then this end of the wick is the lowest the candle went to. I would definitely recommend to take notes on this, especially if you're very beginner, but it's not a really hard concept, so you don't really have to. But in essence, that's what it is. Then, if this is a green candle, meaning price went up during this candle, right here, the bottom of the body, that's where price opened. That's where price went directly from. So that means that price went from here, this closure, to right here, and then, in the same sense, this closure to this open here. So then, like you saw, the top of this body is the closure. This is where price ended up. And then, this is probably unnecessary, but just to kind of help out in case it's not clicking. Same thing with the ends. Highest it reached, lowest it reached. And then the body of this one, the top is the open, bottom is the close. So you can kind of see right here, just getting into the real basics, you can see price opened on this candle right here. This is the one we're looking at. Price opened here, then it closed here, and then it opened here, closed here, opened here, closed here, opened here, closed here, and then it opened down here and closed up here. Real basic. So now that we understand what each point of the candle actually means, we can get into the trends and how this affects those. So by definition, it doesn't matter the time frame. Obviously, you're going to want to know your time frames and know what's significant, what's not once you start trading. But just a brief overview, right here, this is the high. So if we're using microstructure, high, low, high, and then low. So based off of this, if we have this first high, then this first low, then this first high, and this first low, we'll expect a low that's lower than, or a high that's lower than this last high. So right here, and then directly after it, we get this low that's lower than the last low. Pretty obvious downtrend. Would I trade off of that? Absolutely fucking not. That's not enough confluence, but it's just there. So let's go to another example. We'll go pure microstructure right here. High, low, right here. So we have high, then we have low, lower high, lower low. Right there. Textbook, microstructure, downtrend. But, like TJR said it multiple times, a lot of other people have. From this trend, it's going to work on it's a liquidity concept, so it's going to work on every single time frame. So if we go here, and I mean, it's a basic downtrend or uptrend, so it's just something to spot. It's nothing crazy. High, low. This is more of a macro structure, a bigger structure. This high, and then actually, no, we could use this one right here, and then that directly causes this low. So when we're in a trend, every high causes the low, and every low causes that high. And that's a really easy way to think about it, because then you're not looking at all this shit. You'd never want to set up a trade on microstructure because it's so prone to changing, but you could absolutely take a trade off microstructure. Matter of fact, I do very often if you have a few other confluences, and you're very confident in that. So, I mean, just based off this, you could very well put in a decent trade. Now, the problem with this, even though you could put in a trade, is it necessarily a good idea? Maybe, maybe not. You're going to have a wide stop loss. You don't know when price is going to reverse. You don't have enough confluences learned yet. But it's possible. So, we have this high after this low. And then we have this low here. So we could place this low causing that high. And then this low causes this high right here, which is lower. So maybe you enter on right here, this break of structure, once we go lower than this low. And then we draw our little short position. You enter on this. Put your stop loss at the last, you could even put it here. This could constitute a swing low. I would definitely put it here, especially if you're very entry level, but put it there. And then you're waiting. The issue with this is, how are you going to predict where the next low is going to be? The answer to that question is you're not. So this would work, but it's pretty flawed because you really don't know anything until you see a swing. So for this short-term little downtrend example, you don't really have anything to invalidate the trade idea until you see this low, this high right here, and then this low, and then this high that's higher than that last high. So just based off of this, that would be a losing trade. So that's why you wouldn't want to trade off of something very basic like this. Now, if you can kind of merge a few concepts, you learn a little more, then you can get into it, If maybe, say price really wanted to come to this point, right here, and then say you had a ton of confluence, maybe it's not going to completely reverse, but there's a sign that there's going to be some sort of reaction right here. Then you could be like, and this is really the basics, you could be like, okay, we have some type of little break of structure right here. So you see that, you enter on the low that's lower than that last low. So just right here, which we'd want to go candle closure, never get in a trade on a wick or leave on a wick. And then put it at that last high. Actually, one could reason that last high could be substantial here. And then go over to here. You see this, and then you can get in off this micro break of structure. So you see this high, and then this low, and then this high that's higher. Then it's not great because you're not pairing it with other concepts, but you just made over a 1 times return, which is not awful. So that's the biggest thing. It's kind of just a introduction to this market structure, why market moves this way, how to analyze trends, how to see trends, and how to kind of capitalize off them. I wouldn't ever really put in a trade just based off that, maybe on a paper trading account just to kind of learn why market's moving the way it is. Nothing wrong with that, but we'll teach a little more. We'll get into more advanced concepts, kind of spotting areas where price is prone to have some sort of reaction. Because that's really how you're going to know. That's how you're going to top tick and bottom tick, or at least just formulate some sort of a bias. And then you avidly wait for some sort of confluence, some sort of confirmation it's moving in the direction you want to make it move in. And then you have to figure out where you want to have your take profit, which is going to be some sort of liquidity most of the time, which I'll teach about later on. But real brief, quick little introduction into trends, market overview, why it moves the way it does, and then homework. I would say kind of just go on any sort of chart, whether it's on your phone, laptop, whatever you have, And just don't even like really make a trade idea or anything out of it. Just analyze it and find at least some sort of trend confirmation where you can see a high, a low, and then a higher high followed by a higher low. And then just mark it out, mark that out, I would say about 5 to 10 times. And then after you're done with that, if you want extra credit, go for formulate some sort of trade idea. I would do that like 3 to 5 times. Obviously, you're not going to know a whole shit ton about what you're doing. So, don't confuse yourself by doing it. But if you think it'll give you a better understanding, go for it. If you don't. Have a great night.